Friends, in studio with us, a new guest. I'm excited to have our ears and our hearts and our minds blown here with the things that are happening when it comes to investing. From Edward Jones, Russ Boyle, how are you this morning, sir?
I'm great, Eric. Thanks for having me.
You bet. Thanks for being on Real Estate Radio. And we were talking even off radio about what a crazy ride it's been as of recent.
Very true. Very true. Volatility is in the air. It's kind of like the analogy of a lake. It's been wavy waters.
Yeah. Boy, folks have really captured huge opportunity in terms of wealth earning, and then they watch all of that go in a day or two, and then it comes back the next day, right? It's been crazy. Does your phone ring off the hook during those times, or are people like, I'm playing the long-term game, I'm cool, and we'll see what happens?
You know, a great question, and I think it goes back to, we have conversations with our clients saying, as we create a portfolio for you, we're going to create it for all types of environments and look at the long term. And there are going to be days when the wind comes up on the lake and it is going to be wavy. And those are days where you just kind of hunker down and you try to look at opportunities in the market, and we will contact you proactively. Or if you have a little bit of worry, give us a call. But overall, we're creating a portfolio that handles both sunny days and days where it's really windy on the lake.
We're in the same business, but we're in different businesses. I think of it this way. If you're going to buy a house today and you want to sell it in a year, that's not a great plan.
Correct.
If you have to sell it, do what you need to do, but there are costs associated every time you buy, every time you sell. Is that the same in your market?
It really is, especially when you go on an individual stock level, because you're purchasing a company that you're investing in. And just like any other type of investment that you're looking at, it always has a sale value. So if you're going to buy a company today, and would you be satisfied if it reached a certain level and sell it and take that profit? You'd be very happy. So you remove the emotions from it and kind of set parameters of going, once it reaches this level, perhaps it's time to move on and go to another investment.
Yeah. My first investing happened when I was 21 years old. I come from a single parent home, and when I was 21, my mom passed away as well from cancer. And she was wise enough, even though she didn't have a lot of money, she was wise enough to invest in some things. And after I paid off my student loan debt and bought my sister's portion of the house and the equity there, I had a little bit of money left over. And so I took and bought my first IRA. And in addition to my first IRA, I put some money into some life insurance, even at the age of 21. I had great advisors, but this was in June of 2001. And 3 months later, September 11th, 2001 happened. And that roller coaster as a 21-year-old was as painful as the roller coaster when you're 39 now, like I am, or it doesn't matter your age, watching things go way up and way down. You talk about the waves, like it feels like it's crashing down.
Yeah.
What's the best advice that you can give somebody who is fearful of the crash?
If they're fearful of the crash, we usually say it's all about diversification.
Okay.
So you never want to put your eggs in one basket. Let it be in one.
Except for real estate, of course.
All right.
Yeah.
But real estate is part of a diversification strategy.
Yeah.
Definitely, in regards to saying, I use a lot of analogies that people can relate to, lakes, farmers. And so I'll use a farmer one right now. A great farmer has multiple crops. Mm-hmm. And so hence he has corn, soybeans, oats, sugar beets, all those different things, cattle. And so that he's diversified. So as the markets go up and down, your investments, just like in the real estate investments, stocks, bonds, mutual funds, CDs, cash, make sure you got a well-diversified portfolio, life insurance, so that all of those different vehicles are going to take advantage and benefit you in the long run. But in the short term, some of them aren't going to be performing as well, just because they're all cyclical.
So in order to have a robust portfolio, similar to a farmer having a robust farm, you got to have a lot of acres.
Correct.
You got to have a lot of land. And for a farmer that has just a few acres, they probably shouldn't plant wheat and corn and soybeans and everything else. They need to do one product that will yield them what they need to. So if somebody's listening right now and they're thinking, listen, I just have a couple smidges of money that I need to invest, how would you direct them?
Good question. And again, what we would do is sit down with them.
All my questions are good. Okay.
All right. Deal.
Oh, my. Everybody's eyes are rolling right now. This feels great.
It looks at it. First off, that customer would come into the door and we would do a risk assessment on them, because it's not a one-size-fits-all. Not every 35-year-old male is the same. Everybody has different risk feelings. It's kind of like, again, the analogy of Valley Fair. I say to them, if we would go to Valley Fair, would you ride on all the rides with me? Because I'll go on all of them. And if they go, no, I wouldn't go on the corkscrew, then it tells me what their risk levels are. Again, if they've got 50,000...
By the way, you're showing your age when you reference that the corkscrew is like the wild ride at
Valley Fair. It is, I know, right?
What a great ride.
But you look at it of saying a person's got $50,000 because they inherited it, but they don't have a lot of other money. To your point of the farmer being diversified, probably not going into straight individual stocks for that individual would be best for them because of the volatility of those individual stocks. More as going into a mutual fund, which is like a box of color crayons, 84 pack, 120 pack, where there's 120 companies in there. And if one of them have a bad day today, doesn't mean all other 180, 150 are going to have a bad day. So therefore, you're better diversified, if you will.
So what are the outside influencers and situations that are going to affect the tide rising or lowering? Is it the global economic market? Is it the things that Trump says or doesn't say? Is it local economy? Like, what are the influencers on the dollars that we invest?
Good question. Yeah. Again, the thing that I look at with it is every time the market has volatility, it's due to uncertainty.
Okay.
And so there's factors out there right now in economic conditions of uncertainty, Brexit, Trump's tweets, China trade deal, interest rates. All of those things right now are different things that are affecting the market due to uncertainty. Are interest rates going to rise? Are they going to drop again? Is Trump going to tweet some more? And what is he going to say this time? Are we going to get a trade deal with China? All of those factors. Is the European Union going to settle things down? All of those affect the markets. And so all that uncertainty makes it something that can, if you sit down in front of a chair and watch TV all day, you can go stir crazy, really, versus just going, let's create a plan, set the plan, follow the plan, and be disciplined on it.
Great advice. We're going to categorize people into three areas, three silos, if you will. We have super conservative, moderate, and risky. Somebody who's super conservative, where should they put their money?
Gosh, on a super conservative nature, CDs.
Okay.
Laddering CDs, truly, because if they are super duper conservative, CDs is a great start. And perhaps putting them into some sort of other balanced fund may be appropriate, but again, all depends on their overall risk levels.
Right, and the amount that they have to invest too,
Most
right?
definitely.
Okay, how about somebody who's moderate?
Depends on their age.
Okay.
A 35, 40-year-old that's a moderate individual, again, very diversified portfolio with mutual funds mixed in with stocks if they have the appetite for it, including some fixed income investments, probably very appropriate for them.
And then those that love the risk and love the gamble, am I safe in assuming that's the stock market's where some of your money should maybe be invested?
Those that are super duper risky, and have a high equity only risk tolerance, that would be, very little CDs, very little fixed income, and going into straight individual stocks, as well as, equity heavy mutual funds and exchange traded funds.
What I didn't hear in there are things like Bitcoin and cybercurrency and that, because what a crazy run that's been. But that's a totally different show and a totally different topic. Russ, this is really helpful advice for people. If you are sitting on a chance to have the opportunity to have your money start working for you instead of you working for your money, Edward Jones has been a great representative for years and years, and here you are doing great things with us. And so if people want to learn more about you or contact you for services, how should they do so?
Yeah, definitely. They can reach us at our Fargo office is just off of 32nd Avenue and 15th Street.
Okay.
Or they can reach us on the telephone at 701-212-4195 or via email at russ.boyle@edwardjones.com.
I love it. Russ, sounds like you have some great advice and your clients are lucky to have you. Folks, we're going to head to break. In the meantime, go to hatchrealty.com and take a look at some houses. This is Real Estate Radio with Erik Hatch.